Greetings, good people. This is Jonathan Camarda, your humble CIO. And where to start? As always, there's a full plate to go over. So let's start with the macroeconomic, the geopolitical. I don't need to tell you, obviously, the chaos in the Eastern Bloc. From a human tragedy standpoint, it's just horrific. Now, that's not the motif of this channel, so that's all I'll say on that. The bigger picture on the financial end could also wreak havoc globally. As you may recall, back in '98, when Russia had some financial situations, had some real repercussions globally. Could be looking at the same here as the sanctions and the seizing of finances, and then also the energy importance of that country. Could cause, again, a lot more volatility as you're seeing on a day like today. A lot of our clients not getting too wet, so to speak, but we'll get to that in a bit. Now, as we look from a macro level, many different things we're looking at. Obviously, the Fed chief spoke the other day. The markets liked what he had to say as he was looking at a target of 0.25, 25 basis point hike, a lot more dovish than Bullard at a half a point or a point. Of course, that was before some of the Russian-Ukrainian situation. So again, Powell seems to be calibrating the global macro, which is good, in account the speed of which he starts to increase rates. Now, bigger picture is they're trying to stave off inflation. However, there are now signs that, knock, knock, it ain't inflation, pardon my English, at your door. It could be recession. And here's why. As energy prices continue to go up, which a lot of our clients, by the way, are participating and profiting from that. However, from an economic standpoint, that could lead to a recession, as that makes most folks, especially lower income folks, poorer, quote unquote, when the cost of food, and certainly in this case energy, and of course agriculture, wheat, etc., goes up. Lower income, a lot of society, that really creates a downward pressure on their standard of living. Now here's the issue. That in confluence with the Fed raising rates, with GDP growth, by the way, in the 2-3% range, maybe not as strong as everyone thought, and then all of a sudden towards the end of the year, again, you could get the big bad wolf of recession and not the bear of inflation. So kind of picking your poisons there. Now, when we get to what the economy looks like more at a micro level, jobless claims are down 30% since the beginning of the year. That's a positive, as employment has looked pretty good. Wage inflation, of course, is something to watch out for as folks are demanding more out in the workforce and increasingly getting it. So you do have a confluence of tides there, on inflation and then in the back half recession. A lot I know. However, again, we have to keep our eye on the ball. Now, you may have noticed as well, on top of that, with your strategy, most of our clients and strategies have held up very well with this volatility because, again, we have transitioned, again, from a lot of liquid type assets and your technologies and as such to, again, more of your fertilizer companies, energy companies, defense companies, cybersecurity, etc. So, when we said on the last video, is not to get caught up in the individual symbols and the trades, but look at the end of the game box scores as far as runs, hits, and errors. You'll find on days like today, when it's really wet out there, metaphorically speaking, you're hanging out a lot more dry than a lot of the folks around you because of that, the tactical approach. Again, as we continue to cycle through this correction, this is usually a seasonally strong time of year. However, again, the geo-macro situation could certainly trump that. Now, another thing I'll tell you about on the recession front as an aside, read an interesting piece today. And what this suggests is that the last 50 years, a big precursor to recessions has been an inversion of the yield curve of the 10 and a 2-year, and then reverting back to being positive, and then a stopwatch of 6 to 8 months before recession hit. Whoa. What did he just say? All right, so let me rewind the tape and try to define this. Now, a lot of you probably hear inverted yield curve on TV or on the news channels by the wonks and the talking heads, right? Which I guess I'm kind of becoming one here. So let me try to debunk that, okay, demystify that on a Friday afternoon for you. So here, as we go, 10-year yield, you see it on TV all the time. It was just above 2, right? And now it's dropped down. That's that's usually what is used as a baseline for measuring where the yield curve is. The 2-year, which is the very short term, which the Fed has a lot more control over in the short term, essentially is on shorter term expectations, what the Fed can control. The Fed can't control the longer term rates. Imagine a fishing line in the water, right? You can control what's right near your boat. Not that I'm I'm really not a great fisherman, but the farther out you go and the heavier that fish may be, the harder it is to control. Those of you that go offshore, you know what I'm saying. So here's the deal. When that 10-year yield, think of a seesaw, is above the 2-year, that's usually a good economic growth situation, right? Expectations for the future are going up. When that 2-year starts to teeter above the 10-year, okay, that's when expectations are going down for the future, and that's a recessionary situation. So last year we had about 1.59 percent, 159 basis points of a difference between the 10 and the 2-year. It's down to 31. So imagine if you're looking at a football game, you had a 16-point lead going into the fourth quarter. Now you have a 3-4-point lead, right? Makes a lot of sense to a lot of folks out there. Why didn't you just start with that? I'm not smart enough. Apologize. So here's the deal. We're now down to 31 basis points. So what we will watch to see is if we go negative, if we give up that field goal difference, and now we go negative with the 10-year being below the 2-year, and then we start our stopwatch, and then we have to obviously gauge to see if recession could be on the forefront. And recessions generally bring on bear markets more than inflationary situations. So there's a confluence. It's a real gray area. Now, as you notice on your accounts today, the last several weeks, our clients are looking very good on a day like today because we've already begun to hedge. So as I mentioned, is not getting caught up with the individual trades, but the score, like we said, at the end of the game, and a risk-reward basis, what they call in Wonkland, value at risk. You guys are looking real good, and of course we'll continue to tighten the nuts and bolts as we see perhaps more metaphoric precipitation coming. That's all I have for today. I'm sure you already had enough of me. So whatever you're doing tonight, this weekend, enjoy, stay frosty. Again, we appreciate your time, patience, and most importantly, your trust. Jonathan Camarda, and we'll see you next time.